10 years after joining the EU, Poland still has doubts about joining the Eurozone. But could the current geopolitical tensions spur this decision on? William Jackson joins me down the line to discuss. William, the zloty depreciated by 1% in the last month, causing some analysts to suggest the lure of the single currency may increase. What do you think?
On the face of it, there are some reasons why joining the single currency may be attractive for Poland. The zloty's tended to fall quite sharply when there have been periods of market turbulence, whether that's caused by the geopolitical tensions such as the crisis in Ukraine, or when there are problems in the Eurozone, as happened in 2011 when the debt crisis surfaced. And a weaker currency in turn causes problems for the economy. It raises inflation, which eats into households' incomes. And it also raises the cost of servicing foreign currency debts, which are quite large in Poland. But equally, however, a weaker currency also brings some benefits for Poland. And crucially, Poland's a very open economy with a large manufacturing sector, so a weaker currency also makes its exports more competitive. And on balance, I think probably the latter argument is stronger. Poland benefits slightly more from a weaker currency than it does from sort of the stability of being within the Eurozone.
According to their finance minister, all benefits that Poland may be able to get from a Eurozone entry, including boosting its political stature in Europe, hinge on the country being economically strong. Officials also voiced their opinion that joining the Eurozone today is tied to different obligations than in 2004, when Poland said it would adopt the euro. So if not now, when do you think Poland may make the change?
I think the debt crisis in the Eurozone of the past few years has really put attention back onto the problems and the rigidities that can be caused by joining the single currency bloc. And a country like Poland actually still has a long way to go to sort of converge more with Western Europe. Income levels are much lower. There are problems in the labour market, which is quite inflexible. So I think there really need to be quite a large series of reforms to be made to make Poland's economy more flexible before it can join, and I think income levels need to converge further. So to be honest, I wouldn't be surprised if Poland didn't join this decade. I think it's more something for the 2020s.
Today saw rates being held for a 10th straight month. Most central bank officials are saying rates will stay steady until at least end Q3, but some doves advocate no change until 2015. External analysts believe Q4 would be best, as the rise would be more gradual and impact more limited. But what is your expectation?
We've actually argued for a long time that even though the Polish economy is recovering, there are still large amounts of spare resources in the economy, which should keep a lid on price and wage pressures. And we don't think inflation is going to rise substantially over the next 2 years. It should remain below the central bank's target. And as a result, we think the rise in interest rates will be very slow. We actually expect the first interest rate hike in 2015. And we've been expecting that for a long time. Now, there's a growing debate within the MPC about whether it should come in Q4 or 2015. I guess this is a small point. And I think the bigger picture is that it's come later than most expected, and when it does eventually come, it's likely to be very gradual.
The Monetary Authority will receive its next inflation and economic growth projections in July, and that's probably when the central bank will modify its guidance. Belka also announced last month that they are preparing for the next phase of market turbulence. Now, tensions continue to rise over the Russia-Ukraine situation. What stage do you think these unconventional measures will be implemented?
I think it's tricky to know quite when these will be implemented. I suspect they'll do a lot of background work to see how it will affect banks and try to just generally gauge the impact on the economy. So I don't expect it's going to be introduced very quickly. But I think if we take a step back, these are quite reassuring. It sounds, while there hasn't been much published about what their intentions are, they do seem to be looking at ways they would deal with banks that get into trouble during market turbulence. And the fact that the central bank raised the prospect of loan-to-value ratios suggests that they may be trying to prevent a repeat of the credit bubble that occurred in the previous decade. So I think these all seem quite prudent measures.
William, great to speak to you. Thank you very much for your insights today. Well, viewers, that's a big week ahead for the single currency. Ben Jones will be looking at the euro retail sales ahead of tomorrow's ECB meeting. So make sure you keep clicking back to the website for the latest updates. For now, though, it's goodbye.